Hello, everyone. My name is John Whitefoot, and welcome to another episode of Income Investors. With me today is Mo Zulfiqar with another exciting income pick. If you want to read more about what we write on a regular basis, check out incomeinvestors.com, or you can click the link in the description below. If you've been in the markets long enough, you notice something quickly. Everyone wants income, but very few people actually know how to judge the quality of that income. Investors chase high yields and buy whatever looks attractive on the surface, but here's the part most people overlook, and that's a dividend is only as strong as the business behind it. The stock market is filled with noise, predictions, and distractions, but numbers don't lie. The smartest income investors, pension funds, endowments, and others focus on a handful of core metrics. They don't guess, they verify. Mo is now going to share with us seven numbers that every income investor should know, and that will help them avoid future headaches. Mo, what is the first number that every income investor must know?
Thanks, John. I think the first number that every income investor should know is dividend payout ratio, and I think that's where every dividend investigation should begin. Think of the payout ratio as the company's budget. It essentially tells you how much of the company's earnings are being handed out as dividends to shareholders. The lower the payout ratio, the more flexibility the company has to handle, any slowdowns without touching the dividends. Many investors fall in love with the company paying out 90% of their earnings. And sure, the yield looks fantastic, but one hiccup in earning, and the dividend is suddenly the first thing on the chopping block. I think there is certain rule of thumb that one could follow. Any payout ratio under 50%, it essentially means that the company is taking its dividend very seriously. If the payout ratio is between 50 and 70%, you know, the it's fine if the business is in stable condition. And above 80%, you got to be a little careful. You might be walking, on thin ice in some cases. Remember, dividend should feel boring and not stressful.
Thanks. And what's number two?
John, I think the second most important number that income investors should look for is free cash flow, or FCF for short. Um, you see, earnings can be managed, but cash flow is the truth. Free cash flow at the end of the day is what's left after the company pays its bills and invests in itself. If dividends aren't covered by the free cash flow, then management is playing a dangerous balancing act. It is also very important to understand, and generally speaking, if free cash flow is trending down, dividends eventually follow that direction too. You want companies that consistently generate more cash than they need, and that's how dividends stay safe and eventually grow. I think dividend investors should look out for multi-year of positive free cash flow, FCF that's comfortably exceeding dividend obligation, and you don't want to see erratic swings, quarter to quarter. Predictable cash flow again equals predictable income.
What's the third most important metric income investors should look out for?
I think the third thing to watch is debt to equity ratio. Debt isn't the enemy, but it can turn into one very quickly. Interest rates rise or credit market tightens. Companies with excessive debt can get squeezed. And guess where the pressure shows up first? It's the dividends. The debt to equity ratio essentially tells you how leveraged the business is. A little leverage is very normal, but when debt becomes a central theme of the balance sheet, income investors should pay attention. A company with too much debt may want to pay the dividend, but the bank gets paid first. I think what income investors should look out for is a reasonable debt level compared to the industry peers, a debt load that matches the stability of the business. In a lot of cases, utilities can run higher debt because their cash flow is stable. Tech companies with inconsistent cash flow, not so much.
Thanks. And what's the fourth important number?
The fourth number is interest coverage ratio, and I know this one doesn't get nearly enough attention. It tells you how easily a company can cover its interest expense with operating income. When interest rate coverage gets tight, the management has, very limited options, and in that case, dividend becomes a luxury. Companies don't cut dividend because they want to. They cut because they have to vast majority of the time. And poor interest coverage almost forces their hands. Whenever this number weakens, you gotta pay very close attention.
Thanks. And now what's the fifth number?
The John, I think the fifth number is revenue trend. It's again, it's basics, but I think sometimes a lot of investors forget this. A dividend is a byproduct of the business. If the business is shrinking, the dividend eventually follows. You really don't need explosive growth as an income investor, but you do need some consistency. A company with flat or rising revenue can support its dividend, but a company with a declining revenue is planting the seeds for future problems. If revenue is shrinking year after year, income investors shouldn't try to be a hero. There are too many stable businesses out there that, they could look at. I think look for a stable top line performance, and income requires stability.
Thanks. And what is the sixth most important number?
In dividend investing, track record tells a lot, and I think dividend history is very important. A company with a history of raising or maintaining dividends through, thick or thin, is sending you a message that there is discipline embedded in the business. Dividend aristocrats, for example, isn't just a list. They are case studies of how strong companies operate. And when somebody is looking at the dividend history, you got to ask a few questions. Things like, does the company cut during downturns in the economy? Does it maintain dividends even, in tough periods? And has it raised the dividend consistently? If management has spent decades protecting and increasing the payout, that tells you all you need to know about their priorities.
Thanks, Mo. And what's the seventh and final most important number income investors should pay attention to?
I think this is the most important measure, and it's the insider ownership. When insiders own real stakes in the company, they really think differently. They're not just there collecting salaries, they're riding the same roller coaster as shareholders. So when you see insiders buying, it often means confidence in cash flow and ultimately the dividend. And on the flip side, low insider ownership combined with, reckless acquisitions or rising debt tells you the management may be more focused on, things like empire building than rewarding shareholders. Again, insider ownership can align incentive perfectly.
Yeah, thanks, Mo. Just to recap, income investing works best when you strip away the noise and focus on fundamentals. Strong businesses pay strong dividends. Weak businesses pay attractive dividends right before cutting or suspending them. Let's just again recap the seven important numbers that Mo highlighted, and that's a payout ratio, free cash flow, debt levels, interest coverage, revenue stability, dividend track record, and insider alignment. If you follow or keep these seven in mind, that should keep you grounded as a income investor. You don't need to predict the economy. You don't need to time the market, which is impossible anyway. You just need the discipline to look under the hood before you buy. Remember, income investing is a long game. These seven numbers make sure you stay in it. Now that's it for today. Make sure you go to incomeinvestors.com or click the link in the description below to see what we write on a regular basis. We'll be back with a more income picks soon, so stay tuned. In the meantime, don't forget to like the video and subscribe to our channel. Goodbye for now.